Welcome to episode 20 of our series. Today, we are diving deep into professional usage of indicators. We will look at why tools like the Relative Strength Index, MACD, Bollinger Bands, and the Average Directional Index are incredibly powerful for professionals, yet consistently fail for the average retail trader. The secret isn't in the math. It is in the application. The biggest trap most retail traders fall into is working backwards. They look at the indicator first and the price second. A 2023 study on the Relative Strength Index and Bollinger Bands found that while these tools achieved 65.6% and 70.2% accuracy respectively when used alone, their combination jumped to 87.5%. The real gap between amateurs and pros isn't knowing the formulas, but knowing when to ignore a signal entirely. We are going to learn how to use these four tools as a single coordinated system. The first rule of professional trading is that market type determines everything. Before you look at a single line or bar, you must classify the market as trending up, trending down, or range-bound. An relative strength index reading of 75 means something completely different depending on the context. In a strong uptrend, it is a buy the dip signal, but in a sideways market at resistance, it is a cue to short. John Bollinger himself teaches that identifying the market state is the mandatory first step, and your choice of indicator must follow that classification. Let's talk about the Relative Strength Index, or RSI. The default overbought and oversold levels of 70 and 30 were built for range-bound markets. In a strong trend, the RSI can stay above 70 for weeks, and if you sell every time it hits that level, you're essentially fighting the trend. During the 2021 S&P 500 rally, the RSI remained above 70 for 14 straight trading sessions, while the index gained another 4.2%. Professionals treat these overbought readings during a trend as confirmation of momentum, not as a warning to reverse. In a confirmed uptrend, pros use the 40 to 50 zone on the RSI as a buying opportunity, not the 30 oversold level. When the RSI pulls back into this range during an uptrend, it is just healthy consolidation before the next leg higher. The professional rule is simple. Buy RSI pullbacks to 40 to 50 in an uptrend, and sell RSI rallies into 50 to 60 in a downtrend. This shifts your perspective, turning the RSI from a simple reversal tool into a powerful filter for trend continuation. Bearish divergence happens when price makes a higher high, but the RSI makes a lower high, signaling that momentum is dying under the surface. A perfect example occurred with Tesla in late 2021. The stock hit an all-time high of $1,243 per share in early November. But the RSI formed a lower high compared to its peak in late October. The stock then dropped 32% over the next 2 months. Divergence isn't a guarantee, but it warns pros to tighten their stops immediately. Wells Wilder, the creator of the RSI, considered the failure swing his most reliable signal. It is more robust than simple overbought or oversold readings. A bullish failure swing has 4 distinct parts. The RSI drops below 30, bounces back above it, pulls back but stays above 30, and finally breaks above the prior peak. This pattern reveals that sellers have run out of steam. The fact that the second test fails to push the RSI back into oversold territory tells us that the selling pressure has effectively dried up. Most traders only watch for MACD line crossovers, but professionals focus on histogram divergence. This is the difference between the MACD line and its signal line. This divergence often appears 2 to 4 candles before the MACD line itself diverges from the price, giving you a crucial head start. When the price makes a new high but the histogram forms lower peaks, it tells you that buying momentum is decelerating, even if the main MACD line has not yet confirmed the shift. It is a common mistake to think a bullish MACD crossover below the zero line is a buy signal. In reality, it is just short covering. When the MACD line crosses above its signal line, while both are still below zero, it just means the short-term exponential moving average is rising toward the long-term one. Professionals see this as a time for short sellers to take profits, not as a long entry. A true bullish signal requires the crossover to happen above the zero line, confirming that short-term momentum is stronger than long-term momentum. The MACD's biggest weakness is a sideways market. When the market is range-bound, the MACD generates constant false crossovers, a process called whipsawing, where the lines cross back and forth without any real direction, leading to a cluster of small losses. Professional traders avoid using the MACD entirely when the average directional index reads below 20, as this indicates the market is not trending. In those conditions, oscillators like the RSI are much more effective than trend-following tools. Professionals never trade MACD signals in a vacuum. They require confirmation from the average directional index. The rule is to only take MACD crossovers when the average directional index is above 25, which confirms a trend is actually in place. If the MACD shows a bearish crossover but the average directional index shows a strong uptrend is still active, pros ignore the signal and hold their position. Conversely, if the MACD shows a bearish crossover and the average directional index is declining from below 25, the signal gains real credibility. A Bollinger Band squeeze happens when the bands narrow to their tightest range in at least 6 months, measured by the bandwidth indicator. When bandwidth drops below 4% on a major index or stock, it signals that volatility has compressed to an unsustainable level. The squeeze doesn't tell you which way the price will go, only that an expansion is coming. Professionals wait for a closing break above the upper band or below the lower band, accompanied by volume at least 150% of the 20-day average, before they make a move. John Bollinger highlights the W bottom as one of the most important patterns his bands can detect. Look at Apple in March 2021. The price dropped below the lower band, then bounced back inside. On the second decline, the price set a lower low, but the closing price stayed above the lower band, showing that sellers couldn't push the price to the previous extreme. When it broke back above the middle band with MACD confirmation, the W bottom was complete. The key here is volume. It must be lighter on the second low to confirm selling exhaustion. In a strong trend, you will see a stock walk the bands, meaning it repeatedly touches or pierces the upper band and pulls back only to the middle band before moving higher. MasterCard did this throughout 2021. Amateurs see a touch of the upper band and sell, thinking it is overbought. Professionals recognize this as institutional accumulation. Every pullback to the 20-day middle band becomes a potential add point. You only exit this trade once the price closes below the middle band on above-average volume. Bollinger also warned about the head fake, a pattern where the price breaks in one direction after a squeeze to trap traders, then reverses sharply in the opposite direction. Amazon did this in early 2021. After a squeeze, it appeared to break down through a 6-month trend line with negative RSI divergence and high volume. Instead, it reversed and broke out to the upside. Because of this, pros place their stops inside the bands rather than beyond them. So if the price re-enters the bands after a breakout, they can exit immediately. The average directional index, or ADX, measures trend strength on a scale of 0 to 100, but it does not tell you the direction. An ADX above 25 means a strong trend is active, above 50 is very strong, and below 20 means no trend exists. To find the direction, you look at the plus DI and minus DI lines. When the plus DI is above the minus DI, the trend is up, and the ADX simply tells you how much power that trend has behind it. Breakouts fail about 70% of the time, which makes them dangerous. The ADX is your best tool for confirming if a breakout is real. When the ADX rises from below 20 to above 25 following a breakout, the move is likely sustainable. If the ADX stays below 25, it is likely a false breakout. When the S&P 500 broke below its June lows in August 2022, the ADX rose from 18 to 34 in just 3 sessions, confirming that the move had real institutional momentum behind it. Wilder's extreme point rule is a filter that most traders ignore, but it is vital. When the plus DI crosses above the minus DI to give a buy signal, don't enter immediately. Note the high of that crossover day. That is your extreme point. Only enter if the price breaks above that level the next day. For a sell signal, use the low of the crossover day as your trigger. This simple rule eliminates most false crossovers in choppy markets and turns the system into a confirmed breakout strategy. To be a professional, you need a decision matrix. If the ADX is below 20, you are in a range-bound market. Use the RSI for mean reversion and watch for Bollinger Band squeezes. If the ADX is above 25, you are in a trend. Look for RSI pullbacks to the 40 to 50 zone. Use MACD crossovers for confirmation, and look for Bollinger Band walking to stay in the trade. MACD divergence is best at extremes, while the ADX is your go-to tool for transitions during breakouts. Here is your professional workflow. First, check the ADX. If it is below 20, expect a range. If above 25, a trend is active. Second, in a trend, wait for an RSI pullback to the 40 to 50 zone for longs, or a rally to 50 to 60 for shorts. Third, confirm with the MACD. For a long, the line must be above 0 and crossing above the signal line. Fourth, set your stop below the recent swing low or the middle Bollinger Band. Finally, exit when the ADX peaks and starts to decline, signaling that the trend is exhausted. A quantitative backtest of a MACD and Bollinger Band combination on the VanEck Semiconductor ETF from 2001 to 2025 produced some fascinating results. Out of 209 trades, the strategy had a 78% win rate, a 12% compound annual growth rate, and a 15% maximum drawdown. Crucially, the strategy was invested only 11% of the time, staying in cash for the rest. The edge didn't come from predicting the future, but from waiting for high-probability setups where multiple indicators aligned and then risking small amounts. Even experienced traders make three common mistakes. First, they over-optimize parameters, changing standard settings that work across many instruments. Second, they ignore price action. If a stock gaps down on earnings, no RSI reading can justify buying. The catalyst always overrides the indicator. Third, they suffer from analysis paralysis by stacking too many indicators on one chart. These four tools are a toolkit, not a set of accessories. You should only select the one or two that fit the current market condition. The one principle that ties all these techniques together is that indicators do not predict price. They measure market conditions. The RSI measures momentum. The MACD measures trend momentum. Bollinger Bands measure volatility, and the ADX measures trend strength. The professional uses these to answer a single question: is the current state likely to continue, or is it exhausted? When all four indicators suggest exhaustion, RSI divergence, MACD histogram fading, Bollinger Band squeezing, and ADX peaking, the probability of a regime change becomes very high. Context is everything. In our next episode, we are moving beyond individual indicators to explore the complete Weinstein method. We will look at stage analysis, a comprehensive framework using the 30-week moving average and relative strength to track when a stock moves from a base to accumulation and finally to the markup phase. This is the preferred method for long-term investors who want to capture the biggest market moves without getting shaken out by daily noise. Join me then as we learn to trade with the big picture in mind.